In our last video, we talked about a $2 trillion debt wall crushing companies across America. It was all theory, real numbers, real math, but no face to put on it. So today, we put a face on it. Warner Brothers Discovery, HBO, Batman, CNN, Game of Thrones, The Dark Knight, Harry Potter, one of the most iconic entertainment companies ever assembled. And right now, it is sitting on over $38 billion in debt. It just got downgraded to junk status by S&P, and it is splitting itself in two, specifically because of the debt problem we talked about last time. This is the applied version of everything we covered. We're going to pull up the actual numbers, run the actual zombie check, and figure out one question. Does Warner Bros. Discovery survive 2026? Let's get into it. To understand why WBD is in this position, you need to know where the debt came from. In 2022, Discovery, a cable network company known for channels like Discovery Channel, HGTV, and Food Network, merged with Warner Media, which AT&T had previously bought from Time Warner for $85 billion. The result was Warner Bros. Discovery, a massive new media company combining HBO, Warner Bros. Film Studios, CNN, DC Comics, TNT, Discovery Channel, basically everything. But AT&T needed cash from the deal, so Discovery took on an enormous amount of debt to make it happen. When WBD was formed in 2022, it carried over $50 billion in debt. That was already aggressive. Then interest rates went up. The cheap money era that we described in the last video, where rates were near zero, was ending exactly as this merger closed. WBD had just loaded up on debt at what turned out to be the worst possible moment. To their credit, they've been paying it down, from over $50 billion in 2022 down to roughly $38 billion today. That's real progress, but $38 billion is still an enormous number for a company whose core business, linear cable TV, is shrinking every year as people cut the cord. And here's what makes it a 2026 problem specifically. They had $1.5 billion in senior notes at 6.412% mature in March 2026. More debt matures through the year, and the company is simultaneously trying to complete a massive corporate split, all at the same time. That's the setup. Now, let's look at whether the math actually works. Remember from our last video, a zombie company is one that can't cover its interest payments from its own operating income. The interest coverage ratio falls below 1x. It's earning less than it owes. So let's run the zombie check on WBD using their actual numbers. From their SEC filings, here's what WBD's interest expense looks like. In 2024, they paid roughly $2 billion in interest. In the first 3 quarters of 2025 alone, they've already paid about $1.5 billion, running at roughly the same pace. Now let's look at what they're earning. Their adjusted EBITDA, earnings before interest, taxes, depreciation, and amortization, was $6.4 billion for fiscal year 2025. That sounds like a lot, and compared to a $2 billion annual interest bill, it looks fine on the surface. EBITDA covers interest more than 3 times over. But here's where you have to read carefully, because EBITDA and actual cash are very different things. WBD's operating income, what the business actually earns after running costs, tells a different story. In Q1 2025, operating loss was $37 million. They lost money operating the business. In Q3 2025, operating income recovered to $611 million. Better, but it came on $570 million in interest expense that same quarter, barely covering it. And Simply Wall Street's analysis of WBD's financials is blunt. Their interest payments are not well covered by EBIT, with only 0.9x coverage, below 1, technically zombie territory on that measure. This company is not dead, but it is walking a very thin line. Any further revenue decline, and linear TV revenue has been declining consistently, and the math breaks. Remember from our last video, a zombie company is one that can't cover its interest payments from its own operating income. The interest coverage ratio falls below 1x. It's earning less than it owes. So let's run the zombie check on WBD using their actual numbers. From their SEC filings, here's what WBD's interest expense looks like. In 2024, they paid roughly $2 billion in interest. In the first 3 quarters of 2025 alone, they've already paid about $1.5 billion, running at roughly the same pace. Now, let's look at what they're earning. Their adjusted EBITDA, earnings before interest, taxes, depreciation, and amortization, was $6.4 billion for fiscal year 2025. That sounds like a lot, and compared to a $2 billion annual interest bill, it looks fine on the surface. EBITDA covers interest more than 3 times over. But here's where you have to read carefully, because EBITDA and actual cash are very different things. WBD's operating income, what the business actually earns after running costs, tells a different story. In Q1 2025, operating loss was $37 million. They lost money operating the business. In Q3 2025, operating income recovered to $611 million. Better, but it came on $570 million in interest expense that same quarter, barely covering it. And Simply Wall Street's analysis of WBD's financials is blunt. Their interest payments are not well covered by EBITDA, with only 0.9x coverage, below 1, technically zombie territory on that measure. This company is not dead, but it is walking a very thin line. Any further revenue decline, and linear TV revenue has been declining consistently, and the math breaks. Here's the core issue that all the debt math sits on top of. WBD makes money from 2 main things. One is its streaming and studios business, HBO Max, Warner Bros. Films, DC content. That business is actually growing. HBO Max is expanding internationally, the studios are recovering, and streaming subscribers are increasing. The other is its legacy linear TV networks, CNN, TNT, TBS, Discovery Channel, HGTV, Food Network. This business is shrinking, and shrinking fast. Cable TV viewership has been declining for a decade. People are cutting the cord. Advertising dollars are following them to streaming platforms, and the big cable distributors, the companies that pay WBD to carry their channels, are renegotiating contracts at lower rates or dropping channels entirely. The problem is that the linear TV business, the shrinking one, was the cash flow engine that was supposed to service the debt. It generates a lot of cash, but less every year. And if that cash flow declines faster than WBD can pay down debt, the interest coverage ratio gets worse, not better. S&P looked at exactly this math in May 2025 and downgraded WBD's debt to junk status. Their stated reason? Continued revenue and cash flow declines at its linear TV operations. Junk status matters because it makes refinancing more expensive. Investors demand higher interest rates on debt from junk-rated companies, which means WBD's interest burden could actually increase, even as it tries to pay down debt. That's the trap. Declining revenue, junk rating, higher refinancing costs, more pressure on cash flow, more revenue needed to service debt. In June 2025, WBD announced something dramatic. They're splitting the company in 2. Company 1, Warner Bros., gets the good stuff. HBO, HBO Max, Warner Bros. Film Studio, DC Studios, the streaming future. CEO David Zaslav leads this one. Company 2, Discovery Global, gets CNN, TNT Sports, Discovery Channel, HGTV, Food Network, the legacy linear TV networks. CFO Gunnar Weidenfels leads this one. And here's the part that tells you everything you need to know about what's really happening. Discovery Global, the linear TV company, takes on the bulk of the debt, nearly $38 billion of it. Let that sink in. They're taking the business that's shrinking and loading it with almost all of the debt. The streaming company gets to walk away clean. From a financial engineering perspective, this is the move. You protect the growth asset, HBO Max, the studios, by ring-fencing it from the debt. The legacy business either generates enough cash flow to service the debt and slowly delever, or it becomes a distressed sale. But from a WBD Global Network's perspective, this is not a great situation. You are now a declining linear TV business carrying $38 billion in debt, being led by the CFO rather than the CEO, which is a signal of what this entity is really for. The official line is that Discovery Global has industry-leading margins and robust free cash flow. And that's partially true. Linear TV, while shrinking, is still very profitable for now. The question is whether it stays profitable long enough to pay down the debt. And just to make 2026 even more chaotic, Paramount Skydance was reportedly exploring a bid to acquire all of WBD in September 2025. If that deal happens, the entire calculus changes. If it doesn't, both companies have to execute on their own. When a company with this much debt starts showing cracks, junk rating, revenue decline, a split that loads the old business with all the obligations, a specific type of investor shows up: distressed debt buyers. We mentioned these at the end of our last video. Firms like Apollo Global Management, Oaktree, Ares, they specialize in buying debt from troubled companies at a discount. They buy bonds trading at 70 or 80 cents on the dollar, knowing that if the company survives, they get paid back at full value. And if the company can't pay, they convert the debt to equity and potentially end up owning the business. WBD's bonds have been trading at a discount. The junk downgrade in 2025 pushed them further. That discount is exactly what distressed buyers are looking for. Whether they actually move on WBD depends on how the split plays out and whether Discovery Global's linear TV cash flows hold up through 2026 and beyond. But the fact that these conversations are happening is itself a signal about how the market is reading this situation. So, does Warner Bros. Discovery survive 2026? The answer, based on the actual numbers, is probably yes, but not as the company you know today. The streaming and studios business, HBO, Warner Bros., DC, that part is fine. It's growing, it's got a clean balance sheet post-split, and it has real assets people want. The Discovery Global piece, carrying $38 billion in debt while linear TV revenues decline, that's the real question. It survives if its cash flows hold and it can continue paying down debt. It runs into serious trouble if cord-cutting accelerates faster than expected, or if refinancing costs spike further. Here's what we learned from the real numbers. 1. EBITDA can look healthy while the underlying business is struggling. Always check operating income and interest coverage, not just EBITDA. 2. When a company loads all its debt onto one entity in a split, ask why. Usually it means the other entity is the one they actually want to protect. 3. Junk ratings are not just an embarrassment. They make refinancing more expensive, which makes the debt problem harder to escape. This is what applied finance looks like. Same company, same news you've probably heard about, but the numbers tell a completely different story than the press releases. In our next video, we're going back to theory, and we're going to break down exactly how to read a balance sheet so you can do this kind of analysis yourself on any company. See you next week.